Market Monday, 6 p.m. We come on here every week. If you've been joining us, you know how we roll around here. If you have not been here yet, this is Market Monday, which means Monday night we're going to take about 30 minutes, sometimes a little more, sometimes a little less, depends on what we're talking about, how many questions you have, and where we end up, because you can always come on here and simply ask me anything that you want to know about trading, about the markets, about options, about any subject that we cover, or even any subject that we don't cover. I have people out there who are writing into me here at Tradeway, support@tradeway.com, letting me know, Blair, can we talk about this? Can we talk about this for an episode? So we got some episodes coming that are actually created by you. You are the ones who put it together because you had a question, you sent it in, you took your time to do that. We really appreciate that around here because it means I get to talk about something maybe I hadn't thought of, or I didn't know you were thinking of, but now I know you are. And those are the kinds of things I want to talk about, because if you've been on here with me before, one of my goals is to help you trade in the stock market. And more specifically, I like to say, I want to help you win at that. I want to help you get better. If you're going to make an investment of time here with us at Tradeway, we're going to make the best investment in you that we can possibly make. That's what we try to do around here. Today, I'm going to do a market update. A lot happening in the market right now, right? This is a very significant time. In fact, this is a time around our community here at Tradeway, no matter what season we're in the market, and the markets change seasons. It's never the same forever, okay? It is a fallacy. It is a falsehood. It is a delusion that the markets would just go up forever. Doesn't matter who we vote in. Now, that matters, but even if we could always pick whoever we wanted and had a perfect person, the markets would not go up forever. The economy would not go up forever. Now, I think there are things that government leaders can do to make the economy much better, and I think there are things they can do to make the economy much worse. We're going to talk about inflation today, and certainly that's front and center when it comes to the kinds of decisions that are being made. But my point being, it's not always the same. It can't always be the same. Just the same, when it goes down, the markets, it doesn't go down forever, right? We may come into a season where it goes down further, faster than we've ever seen. We may not, but it won't go down forever. Our economy doesn't go up forever. It doesn't go down forever, but it changes seasons. And if you and I are going to be effective at protecting our money and promoting our money as traders, we've got to know how to change the strategy that we are using. And in order to know what strategy we should use, we've got to know where the market's at. And so today I want to look into, where is the market at? What are some trends that we're seeing? What are some changes? What are some of the main things that you can watch for in the days ahead? You might be a long-term buy and holder, right? We have people who join us on here all the time. You know, you're into purchasing companies. You're following Warren Buffett. You've got a retirement account that, you know, you might be in your late 40s, 50s, 60s, right? Even if you're younger, you're interested in learning it. But we've got people from across the board that are in that long-term buy and hold mindset. But we've also got people who are saying, you know what, I'm not even really that invested in that. I'm really looking to learn to trade. I want cash flow, right? You're looking to do something different with your time. Do something different for a career. Do something different. You know that one of the main rules, one of the main things that the wealthy do to get ahead further, faster, with less work, and that's not just a catchphrase, right? This is a reality. They use their money to make money, right? They use their money to make money. That money and that skill set meet to be energetic, right? It's not just spending and saving. It's not just trading time to make more. It's, what are the ways I can put my money to work? And around here at Tradeway, we know that one of the most powerful ways to do that is in the stock market. So we've got to match what we're doing with where we are. We can't do that if we don't know where we are. Now, that said, we're going to talk about it tonight. First, I want to say hello to some friends out there. Mario is on with us from YouTube tonight. We got folks joining us from Facebook, from YouTube. Remember, you can always subscribe to Tradeway on YouTube. Ring that bell, notifications, so we can let you know anytime we're doing something new, which we do a lot here, right? There's a lot of good content you can join in on almost every day right on YouTube. And of course, on Facebook, if you've liked our page, you're going to get those notifications as well. You can always tag friends there too. If there's somebody out there that you feel like needs to hear this as well, you can send that over to them. So back to the task in hand. What is going on in the markets? Well, let's start with the biggest thing. I got a couple things I want to show you guys tonight. I'm going to switch this around a little bit so we can see the charts by Tradeway here. There's a lot of cool functions to this. Taking a deep breath, right? Because we got a lot to look at. I'm going to go over to our charts because the first thing here is to look at the S&P 500, okay? Now, here's the most obvious, and I won't spend a lot of time on this because we've talked about this before, and this is fairly obvious once I zoom out, okay? In fact, I believe we touched on this last week. By the way, you can always go back on YouTube and watch all of our previous episodes. Every single one of them is on there. So if you like what you hear tonight, you missed something, don't worry. You can always go back, right? You can always watch it. There's plenty of content. In fact, if you string together everything that we have talked about in over 2 years, let's say you come in and you don't really know stock trading. You don't really know the markets. You don't know the terminology. If you watched those episodes alone, that would be tremendous, tremendous benefit to that journey for you for sure, because we've covered a lot of stuff. Now, that said, here we are moving up, right? Pre-COVID. This is COVID right here. I'm zoomed out pretty far to give us a good view. But here we are at the bottom of COVID, all right? That's March 25th, 2020. Here's our top. Okay, that's December 31st, right? Cusp of the new year, 2021 right there. Okay, so we're talking March, right, 20 to December 2021. Okay, almost 2 years, not quite, right? Close to a year and a half. Now, look at that chart. We did that in a year and a half. Here is moving up, one of the best economies we've ever had. We talked about this last week. I won't go over that again. We crash in COVID, and then before you know it, it doesn't take very long. By the summer, we're already breaking above the previous highs. Our economy, not necessarily looking tip-top by August of 2020, and yet here the stock market is blasting past those pre-COVID levels because the amount of stimulus, I was just reading an article, Mr. Jeff Bezos and the White House are actually going back and forth on Twitter right now. They got a little bit of a Twitter feud going on between one of the world's richest men and the administration at hand, as the wealthy are being blamed for inflation. Right now, it seems like everybody is to blame for inflation except leadership. That's not how I see leadership. I think leadership, whether it's you or it isn't you, you take responsibility for it. That's how it has to happen. That's why we have them there. But it's easy to sell the narrative that the wealthy are always to blame. Now, I'm not trying to defend things that shouldn't be defended, but the idea that the wealthy are always to blame for everything is a pretty convenient perspective. Now, that said, they're going back and forth, right? And one of the things that has been mentioned is how an enormous amount of money, right, taxpayer money, was spent to do this, to prop up the economy, to prop up the markets, right, to pump money. But you know what? The government can tell us they're not going to tax in one way, but if they spend enormous amounts of taxpayer money, eventually that has to get paid. That has to get paid. And you know how it gets paid? Well, it either gets paid directly or it gets paid indirectly. And right now, we overheated the economy, right? The stock market went up into the stratosphere very quickly, right? And then we end up paying that tax. We're paying it in inflation now, right? We're paying it in inflation. And some of the most vulnerable in our culture are the ones who are going to be hit the hardest by that. This is what I said. I think last week I've said it. I said it, but I've said it even a few times. You don't have to be an economics genius to know that when you look at the economics of a household, if all you do is put the charges on the credit card, that is going to catch up with us eventually. You have to pay the interest eventually. It doesn't work. Now, I'm not saying that the situation with the economy and inflation only comes down to that sort of a picture, but that is very, very important. The idea that we can just go out, spend money, fix all the problems, and it'll never come back, that's not true. And so, yes, the stock market advanced considerably, but it also has created a situation where things are particularly weak foundationally. And here at Tradeway, we're finding ourselves switching away from bullish strategies where we might be buying stock, we might be buying long calls, we might be doing put credit spreads, right? We might be doing short-term vertical spreads, debit spreads, right? And we're going in favor of more neutral strategies, right? Or more very short-term volatility strategies using our options because the markets are bearish and highly, highly volatile. Highly volatile. So what's happened is inflation has driven up the need to raise interest rates. I've said this many times before. Interest rates is the main story of the markets. And I can tell you in just a quick explanation, interest rates make it more expensive to borrow money. If we borrow less money, we spend less money. If we spend less money, we can cool things down a bit. That's the idea. What's interesting to me is if we're raising interest rates because we recognize that we need to spend less, cool things down, then we shouldn't see any more massive stimulus or just spending. But even just this last week, I've seen several more enormous bills passed or at least proposed by the government for spending, huge amounts of spending. And this has created an environment where in the stock market, people are bailing out of assets. They're bailing out and they're predicting a recession. Now, we talked about some of this last week, but here's the most basic thing I want to show you. When you look at a chart, any chart, I want you to look for peaks and valleys, right? The technical term, highs and lows. I want you to look for highs and lows. You know what you can see here when you look at the highs? It's pretty clear. Even if this line isn't perfect, they're getting higher, period. I just gave you an enormous lesson, right? There's more nuance. We can add some more layers to that, right? We can train you. But in the beginning, simply analyzing the price of a stock to say, as a trader, it's making higher highs and it's making higher lows is very helpful. One of the things I've told our students in this market season where it's going down, okay? It's moving down, but some of our students are looking to trade stocks or they're seeing, are there any environments where I can still be doing some directional calls? Now, in many cases, that's unadvisable right now because things are so negative. And we're talking to some specifics of that where we want them to protect themselves by having an appropriate position size, doing correct stop outs, right? Better stop outs, in many cases, tighter stop outs. Risk management in an environment where you know you're moving more so against the prevalent market tone which is both negative in the news and in the chart. Okay. But one of the things that's coming up is, well, let's see if we can't find some charts that are highly outperforming the markets, right? So I've shown you guys this one. I taught a step one this weekend. We looked at this stock quite a bit, right? Does this stock look really, really negative to you or really, really good? Is it hard to see higher highs and higher lows here? What do I mean? Peaks and valleys, right? Peaks and valleys. It's the easiest way to understand that. I draw a second line here, kind of make that line parallel, and I'm just going to pull that into the top. Put it right there. In fact, I'm going to just kind of pull that back so it extends beyond. Right? Peaks and valleys. So what am I saying? Well, there's stocks out there because there's industries out there that are outperforming very much. The market is moving down. But you have to understand, money doesn't just vanish when we get into transition, right? That's what transition is. The money doesn't vanish. See, Wall Street News, since I became a trader, I've noticed Wall Street News sometimes likes to say, they said this about the crypto markets this past week, which I'll comment on before we finish. But a lot of money lost in the crypto markets this past week. Okay? Significant. Fortunes lost in some cases. But sometimes the headline is wealth wiped out, right? 350 billion wiped out. Well, that's true and not true. Wiped out in that it went from one place to another place. Thus to say it no longer exists here anymore. But that doesn't mean it doesn't exist at all, right? Now, there are some cases where that is literally true. It's gone. But in many cases, it's not that simple. And in the markets right now, yeah, a lot of stocks are going down, but that money isn't all going nowhere. It's going somewhere. It's shifting somewhere else, right? The big boys on Wall Street, those mutual funds, those hedge funds, right? Those investment banks, they're putting it elsewhere too, because in times of recession, there are other sectors of the economy and stocks that come up. They rise up. You and I are going to maybe spend money differently if we do go into a recession, but there's still going to be money being spent. Now, there may not be as much money being spent, but there's some things that you and I are going to spend money on regardless. Okay? I'll tell you what, certain areas, this may not be true, but by and large, healthcare, we're still going to use healthcare. If people still get sick, they're going to go to the doctor, right? You're going to turn the lights on. You're going to put gas in the car. Okay? You may not use as much, but you're still going to use it. Whereas going out and getting the latest iPhone may not be so important to you. Having 18 subscription services may not be so important anymore, right? Now, if we think through the way we do that in our daily lives, we actually can start to see that in the charts. What we're looking at on the screen right now, this is an oil and gas stock, right? This is an oil and gas stock. And one of the things I've been saying about, hey, let's find some outperformers, helps me realize it actually doesn't matter what season we're in. Those are the kinds of stocks you want to look for when you're trading. If you're going to trade long calls, meaning you're making money on the stock, making money on the call when the stock goes up, you ought to find outperformers anyway, right? We ought to find stocks that absolutely look like they're refusing to go down and stick to those. If we make money when the stock goes up, let's find a stock that rarely even likes to go down. Now, we've got some rules we need to put around that. We need to learn the skill set and manage our risk. But let's not make it more complicated than it has to be. And the opposite is true. If I'm trading long puts, I'm making money when the stock moves down. I'm trying to find those dogs of a stock. They're just getting killed, right? And that's the kind of thing we're going to be looking for if this market really starts to plummet. So that's a huge thing to remember, no matter what the market season. But right now, buying stocks, trading stocks, buying long calls, we have to understand we're in a spot now where we're not really trading with the trend anymore when we're looking to go bullish. Now, we're not in a bear market yet on the S&P. You'll notice, I'm going to move this line down right there, right? 38.55. That line right there, that's 20% down from this high. 20% down from the high on the S&P 500 is officially a bear market. Is officially a bear market. So I mentioned even last week, that's the line that we'll be watching. I don't have a crystal ball, but I know that's a key psychological level, right? For the traders on Wall Street, for the big money, if we're going to let it go and let the S&P 500 slide into a bear market, that's a pretty big deal. And if I anticipate that some of my big money buddies aren't ready to do that, and we're all watching that key level, then there's a good chance we're going to see a little bit of buying there. We're going to see if those buyers will come in and defend that level. Learning how to do some of those things. Think through what I just said. Watch our coaches do that on webinars every day here at Tradeway. It's very helpful, right? We had students that were going out and going, okay, this might be a good time for me to look at some short-term long positions. Meaning long, when I say long, I mean my position will make money if the stock moves up, right? If it goes in the direction that I've chosen. And obviously that's going to be helped if the market as a whole gets positive and moves up. So let's watch and see if at that level that happens. And we got within 5 points of that level and the buying started. We didn't get a crazy week, but we got a couple of days of movement up. And then today, a real pause. Nothing too crazy, right? It's already slowed down, which tells me that things are pretty bearish out there still. And none of our people were particularly convinced that we would continue to see a lot of bullish action. Now, it's not over yet. We're not in a bull market, or a bear market, I should say. We're not out of the bull market, but we're hit that level, and now we're just moving up and going, all right, look down here. You can see this 10-day moving average. If we break that, we're going to look to move to the 20. If we break that, we're going to look to move to the 50. And we're going to just play it like an elevator from one to the next until and if it fails and starts to move back down. And at some point, retesting that same level, right? I think I was saying to somebody else here at Tradeway earlier today, I think in the future here, the next month or so, I think probably no news or little news will be kind of good for the market. If we get inflation numbers, which we just got, right? So it'll be a little while till we see that again. If we get inflation numbers that are not good, that's going to send the market down most likely. If we start seeing company earnings, which we just saw, that are not good, that's going to really hurt the market most likely as well. If we get another meeting from the Fed or a comment from the Fed that says, you know what, we need to be more aggressive with interest rates, of course, that's going to affect the market as well. Now, we don't talk about all those news items because we trade on news here at Tradeway. We don't. But when I look into the future and I think, well, what's going to stop the market from saying, let's take a break from all this selling and get some buying in? I think not getting bad news will be good news in and of itself. So we'll see how that plays out, because some of that bad news could come at any point. And thus we look at going, okay, red, white, and blue here. Maybe we're going to look at that like an elevator, which is an approach more so for our students who've got some practice here. We're really looking for nice, good, solid patterns on the stocks. On top of that, I'm giving you a pretty good example right here in SU. Now, that said, I talked about things that are performing and outperforming. I know we've got some folks in the comment boxes, so I'm going to come back to that in a second. I want to show you something else I was looking at here. This is very interesting. This is just a part of, Charts by Tradeway, the fundamental data that we can get. What do I mean by fundamental data? Well, long-term buy and holders, you're entering into a long-term relationship. I joked with the students who were with me on the step one this past weekend, we're looking in trading, we're dating stocks. We're not marrying stocks, okay? We are not sticking around for the long term. We are going to stay. And if that stock goes crazy on us, that's it. We're done. We're out. No big deal. Long term buy and hold. We're more interested, how healthy is this company on the inside, right? What different facets of this company can I look at to really get a sense? It's like going to the doctor and saying, Doc, I need a checkup. Give me the whole thing. My heart, my lungs, my blood, my brain, whatever, right? And there's many different tests that they can do to tell me, okay, you're really healthy in these ways, need some work over here, maybe this piece is unhealthy. Well, that's true for companies. And we call that fundamental analysis, right? What's the internals? And Charts by Tradeway gives us a tremendous amount of insight visually to know what's going on fundamentally with these stocks. Well, one of the main things we do right here on this page, you can see over here on the right side. Now, down here on the bottom is what we call a heat map. And it just tells me in a quick snapshot by color, brown and red on the bottom, the negative side, to a green, right? To a bright green on the positive side. So I can see what's doing well. You can see right away, oil and gas today, right? That's the greenest thing on this whole chart. And that's been the case quite a bit. Because that inflation, record gas prices in the United States on average right now, that's going into the pockets of these oil and gas companies, which, I digress a little bit, but I have to say, the war on the oil and gas industry, a little bit of irony, I have to say, a little bit of irony to me that they would try to crush the oil and gas industry, and yet now people have to spend even more money on that. There is definitely a more in-depth conversation to be had there about the nuances of that discussion, but that's distinctly ironic to me, I have to say. Either way, oil and gas stocks being lifted as a result of that. And so you can see up here, if I go to this top chart, and this is what I want to focus on for a minute, I can just come in and I can go, okay, S&P 500. Now I can switch that, right? But I'm looking at the S&P 500, and that's the chart I just showed you, right? We looked at the price chart. Here, it shows me I have 11 different sectors in the S&P 500. Now, just looking at the S&P 500, that's 500 growth stocks across 11 sectors of the economy. It is a diversified index in and of itself. Now, it's not diversified beyond stocks, okay? This is one asset class, if we're talking diversification. If I go out and buy the SPY, which is essentially buying the S&P 500, I'm buying into 500 growth companies across 11 sectors, but I'm still only exposed to the stock market, okay? So that's important to know. But it is diversified. It is a diversified representation of the market, and you can see that broken up here into these 11 sectors. Well, what does this mean to us as traders? What does this have to do with our snapshot today? Well, for starters, today, we're only, day, right? See right there? It's only looking at today, and clearly energy was the winner. Consumer cyclical, clearly the loser here, this guy right here. Consumer cyclical, meaning, well, let's go right here. I can just show you. Okay, some of these, the worst. Retail, vehicles and parts, restaurants, leisure, right? Furnishings, fixtures and appliances, personal services, manufacturing, apparel in particular, right? Those are the kinds of things that's for extra. When things start to get tight in the household, this is some of the first stuff to go. So that's not surprising. But it's only one day, right? So I can come in here and I can look at that snapshot and go, okay, I can see, and this is at the end of the day, obviously, but even in the morning, I can start to see where is momentum happening here. And I can see patterns. But you know what really helps? Let's just move a little bit further out, because now I'm looking at 5 days of trading, right? I'm looking at a week representation. And that gives me a little bit better idea of what the trends are, because I'm not only trading just one day, am I? right? If I was a day trader, maybe that would be more applicable to me. But if I'm swing trading or I'm position trading, I'm in 2 days or more, I'm looking at a little bit bigger time frame. And it's interesting, you can see energy still the big winner, but it shifts around the map a little bit, right? It's not quite the same. Now, what's really interesting to me is when I start to get out further, let's go out to maybe 6 months. And this gets back to what I was talking about when I say, guys, the season has changed. And what is helpful for you about stock trading, right? You're looking at trading. Well, we got to look for the things that are not performing, and we got to look for the things that are performing. I really want to find the extremes on both sides. I want to avoid, as a buyer, if I'm trading stocks, right? I want to avoid anything that's not in that top, absolutely top performing industry as a trader. I'd rather trade with momentum. I'd rather trade with momentum any day. Now, there's price action and there's price edge. You've heard me say this before. Price action to me is just price movement, and there's price movement every day. If price movement is all I need to trade, then I'm running all over the markets, throwing money at all kinds of stuff. Well, that's not going to help us. We're not going to get ahead doing that. I know this because I was taught how to focus in, and I have chased price action. We don't want to do that. We want price edge. Price edge is when we have a pattern, support and resistance. We define the risk of the trade. We have positive risk return. We know our entry, our stop out, and our exit, right? The process of defining a great trade, that's our edge. That's our edge. From there, we go through the process of executing the trade. But part of that can be what's really doing well right now. And now I'm out to a 6-month snapshot, and I can start to see more and more what's doing really well. I thought this was interesting. Let's go to, say, a month. A year. Right, so we look at a year, and you can see energy, the big winner, up 60% year over year, by the way. Energy, crazy. Communication services, we're talking Disney Plus, right? We're talking, I'll go over here and show you. I'm trying to think of Netflix, right? Interactive media, right? Google, Facebook, electronic arts, Twitter. This is the kind of stuff. We've lumped this more into the tech as a whole, but more specifically, this is the communication services. Media, if I open this up for you, Disney, Netflix. You can see all these providers, Fox, Dish, and so on, right? These are the things that are starting to shrink up. It's not that these companies aren't going to make any money. Disney's going to make a lot of money. But compared to what they were making to sustain the kinds of stock prices they had, so I want you to know that some of the things you may have been trading consistently, and you may have thought, oh, these are just such great companies. I can keep trading Apple. And I actually saw an article earlier. This is speculative. I don't know what his angle is, but if you've ever seen the movie The Big Short, Michael Burry was one of the ones anyway. In fact, he was the first one to predict the 2008 crash. He is going short on Apple. He's betting against Apple. I don't know his reasoning specifically. I'm not suggesting that we should all go out and short Apple, but isn't it interesting that we're starting to see some major shifts for some investors on the sentiment behind some of these great companies? Because Apple's going to disappear? No, highly unlikely. But is it going to perform for us in this season like it did? Right? Doesn't mean we're writing it off forever. And if I remember correctly, Warren Buffett probably went out and bought a couple $1 billion of Apple recently, for all I know. Somebody out there, if you know that, I feel like I heard that, but you can put that in the chat. So there are varying opinions, but I want you to understand this is part of that season shift. Some of those darling Wall Street stocks that just didn't seem to want to ever go down, well, now that's really what they're doing. And you can see this technology industry, here at a year, still holding on, right? Still holding on. Let me just go even in the last 6 months, though, right? We're getting in almost to June. So we're almost 6 months into 2022. It's been a very negative year. They're starting to raise interest rates like we've been talking about here on Market Monday. If you've been with us, you're starting to get this language, man. You're starting to understand how this is working, and it's becoming an asset for you when you are approaching the markets. That's the goal, okay? Well, you can start to see some shifting here, right? Notice if we look at a year, we still got real estate up, okay? Once we go into the 6-month view, we're starting to see real estate drop, right? Real estate market has been really hot. Okay, we're starting to see it drop. And then we come in a month, right? And we're seeing an acceleration of that drop, how things are shifting. This has been a very negative month. So, of course, we're seeing a lot of things really, really far down. But you can just see how things are shifting. That consumer defensive, right? Some of those things I talked about earlier, that's a sector of those things that we're going to keep using, right? There's much more likely we're going to keep using those things. You can see right here, right? Where even if we go into a recession, people are still going to go to Costco, right? Look at this. We got Dollar Tree. We got Dollar General. We got Kroger, right? We got grocery stores, Walmart, that kind of stuff. And that's a nice introduction into the idea of sector rotation, where the money is not necessarily disappearing. Now, some of it's coming out of the stock market, right? And it's going to go into other assets. It's going to go into maybe lower return, but less risk things like bonds and things like that. But we're still going to see money in the stock market, and we're going to see it change primarily where it goes. If I jump over here, just to put the nail in the coffin, so to speak, on some of those darling stocks, I call them, right? The rock stars of Wall Street that have just gone absolutely bonkers, and in many ways have been responsible for massive increases in the S&P 500, which is very heavily tech weighted. The S&P 500 is down as of close today. I'm going to say about 15%. It's in that ballpark. The NASDAQ was close to about 27, 28% at its low. Okay, that's significant. So it's not double, but nearly double digit or double down what the S&P 500, a more diversified index, is. The NASDAQ, much more heavily tech. So we're seeing those tech stocks, again, those really popular ones, really coming down, okay? So potentially looking at some bearish opportunities in some of those techs. And all I need to do is go out, open up the heat map and say, all right, what are some of the things in technology? And I can go through here and look specifically at technology, communication services, and see how are those things doing. So those are some of the top things I want you to think through as you're looking into, I'm going to take this off, as you're looking into, well, what should I really be looking at right now as things change? I will say this. Every conversation we have with our students right now, when the market is not in a reliable, predictable, repeatable pattern, right? That is a time where we exercise more caution. It is the goal of a trader to make money, but it is the role of the trader to manage their risk. If you manage risk, that's the right route. Get the root right, and eventually you can get the fruit right, right? Some of us get that backwards. I know that because I've done it. I've done it a lot. You got to get those correct, right? You've got to have the right route so you can have the right fruit. So right now, trading, especially bullish trading, got to be extra cautious. We teach you in the program what are the practical ways that I can add added layers of protection so I can be an active trader, but I can know this is the kind of stuff that I have to be doing in this market season, because if I don't, it can be very, very difficult to trade. Phyllis is saying, hello, I'm from Indiana. Hello, Phyllis. Brenda says truth. So there was some truth in there. Mario is with us. I'm going to pop these up really quick. Why not? Let's let everybody see the people. Mario's saying hello. We've got Phyllis in there, right? Brenda, truth. Mario's saying, when our government starts printing more and more money, I think about Mexico. Okay? They just kept printing more pesos. One bottle of Coke got to 800 pesos, right? It's basic economics. You just can't do that, right? It's the supply and demand. The more the supply, the less the value, right? The more the supply, the less the value. Okay, Adam, are you really investing in all 500 when buying an SPX fund? Adam says, don't the largest 10 or so stocks usually get the most leverage? Okay, so there's two things you're going at there. Adam is saying if you buy an SPX fund, like an ETF, like the SPY, SPY is the symbol, it tracks the S&P 500. It's an ETF that tracks the S&P 500. And you can also look at the SPX, by the way. SPY is not the only one. SPY is just the most popular one. So it would be a little bit different between the two, okay? Speaking of the SPY, yes, I should say even just the index itself. Yes, for those that don't know, the S&P 500 that I just showed you, it is 500 stocks, and they are all weighted, right? You've got many different pieces of that pizza, right? And it's cut into 500 pieces. But that doesn't mean every piece is the same size, right? For example, Microsoft, that has a very big, at least in comparison, influence upon the movement of the index. So when one of the tiny stocks in the S&P versus Microsoft moves, this one's not going to influence the index that much, whereas Microsoft is going to influence the index and what it shows us on the chart a whole lot more. They're not all even. You and I don't need to understand all the index weighting. What I do want you to know is that the tech industry tends to have a tremendous effect. Now, it's not at more than 50%. It can't sway the entire index, okay? But it does tend to have a higher impact upon the movement of the S&P because the tech stocks within the S&P tend to be the higher weighted ones, right? Of the top 10, it's like, I think almost half of the top 10, okay? So when I see a lot of negativity in tech and NASDAQ, like it is right now, I am less confident about the S&P, right? Lately, when I'm looking at the S&P, and more than ever, I'm also going and I'm looking at the NASDAQ. Because if the NASDAQ tries to recover, hits the 10-day and drops off, I'm not very confident in the S&P. It may hold out a little better, but so far, 2022, it hasn't. It hasn't. And you've seen it in the headlines. So you make a good point, Adam, in that it's not all equal. But if I buy a fund, there is a weight from each of those 500 companies that is in that. And collectively, the tech, for example, like I was just talking, does not make up such a huge amount that it's more than 50% of the influence of that. That would be, we'd essentially be buying a tech fund, right? Ruben is saying, hi, Blair. Glad to be on the live stream. We're pushing 45 minutes today. Appreciate you guys being on here. Thank you so much. Love the comments. Love the questions. Again, giving you a snapshot. This is where we're at. And I'll say this in closing. I think this is where we're going to be for a little while, right? I think we're going to see big moves. I think we're going to see volatility. I certainly don't think we're going to just drop. I don't know if we're ready to break that 20% line. I think traders on Wall Street proved that, at least in the short term last week. If we get no news, I think it looks like, I can always be wrong, but I think it looks like no news is going to be good news. I think that'll help subside some of the negative emotions that have really driven the selling. But I also think the tech industry is extremely inflated in its asset values still, as a whole, and that creates a real vulnerability, as we were talking about with Adam's question, to see the market moving down. And Adam commented, NASDAQ and S&P have been slightly mirroring each other more than the Dow. And we're seeing that more in that sector rotation. Now, remember the Dow, it's the Dow 30. It's an industrial index, Okay, think about industrials versus tech when I'm talking about that consumer durable versus that consumer cyclical concept. Okay. So that's going to be a bigger disparity. Now, that's not to say if we go into a full-blown bear market, you're not going to see the Dow slide. I'm not saying that, because if confidence in stocks and companies in the economy are coming down, we're going to see that impact the indexes for sure. But as you noted, Adam, I'm seeing a little bit more disparity. We've got the S&P and the NASDAQ over here, but then we've got the Dow, and it seems to be performing a little bit better. I think that's the kind of thing we're going to see continually. Going to see that volatility continuing, uncertainty continuing. And as we do get into another news cycle where we talk Fed and we talk earnings and we talk inflation numbers, I think we're just going to be even more sensitive to those things right now. Whereas typically, we're not trading based on news, and we're still not doing that. But there is a lot of news-driven transition going on. So we find ourselves talking about that a little bit more. And again, learning those skills, tradeway.com. If you haven't taken that course with us, you got to go to tradeway.com, sign up for that step one, start your journey. We're doing live classes all the time. You got to get the foundation in, right? Remember, you can always reach out to me, support@tradeway.com, Blair Nightingale. Let me know your questions, thoughts, concerns, ideas that you might have, questions that you might have for an upcoming episode. I would be happy to cover it. We do have a few coming up. I will announce soon, because students wrote in and let me know some things they'd like to look at. I think they're great topics. I think they're great. And that's what this is really all about, is you and I connecting, interacting, so that we understand better, feel more confident. If we're more confident, we don't chase the market. We don't force with the market. We can make better decisions. And that's super, super important. Stay safe out there, guys. Appreciate you. Thank you so much. We will see you next Monday. Have yourselves a great night.